Good morning, guys. How are you all? Fine? Doing well? Hale and hearty? Okay. So, we were supposed to move on to the next chapter, which is marginal costing. Okay. So, first of all, what is the meaning of marginal cost? Okay. So, let's see. Suppose, okay, we are manufacturing, let's say, 100 units. Okay, how many? 100 units. Now let's say the variable cost per unit is 2 rupees. Okay, and the fixed cost is say 500 rupees. So we know that costs are classified into variable costs, fixed costs, semi-variable costs. Semi-variable costs are those costs which have both components, fixed component and variable component. We had seen the differences between variable cost, fixed cost and semi-variable cost when we did chapter 1 that day, right? So variable cost was that cost which varies with output, and fixed cost is that cost which is not dependent on output. So now we are manufacturing 100 units. So can you tell me what is the total cost associated with these 100 units? How will we calculate total cost? Total cost will be total variable cost plus total fixed cost. Now whatever I have given you here, total fixed cost, that is in terms of total only, right? But variable cost I have given per unit. Why? Because it varies per unit, or it varies with the output. So now for 100 units, if I ask you to calculate the total variable cost for me, how will you calculate? 100 into 2, correct? Number of units into variable cost per unit. So how much do you get? 200. Then total fixed cost is already given to us, which is what? 500. So total cost will be how much? Total fixed cost plus total variable cost, which is 700, right? Now, let's say I am manufacturing 101 units. Now tell me what the variable cost will be. No, I'm asking how much the variable cost will be, not the total cost. So you've already jumped the gun. Okay. So tell me how much is your total variable cost. 101 units, because now I'm producing 101 units, not producing 100 units, into rupees 2. So 202. And what will my fixed cost be? Will fixed cost change? Will you do like, oh, for 100 units it was 500, so for 101 units how much will it be? No. Why? Because fixed cost is supposed to be fixed. It does not change with your output. So whether I'm manufacturing 100 units, whether I'm manufacturing 90 units, whether I'm manufacturing 110 units, it will not matter. My fixed cost will remain fixed. So fixed cost will remain at 500. So what is my total cost now? 702. So guys, when we manufactured one additional unit, that is from 100 to 101 units, one additional unit, what was the additional cost that I had to incur? 2 rupees. How? See this? 702 minus 700, which was 2 rupees. What is this 2 rupees? Your variable cost. So in other words, marginal cost is nothing but your variable cost. Marginal cost is nothing but your variable cost. So in marginal costing, what we do is we divide our costs into these two parts. One is variable cost, one is fixed cost. Okay, so the marginal cost statement or the marginal cost sheet looks something like this. We start with sales, okay, minus variable cost gives us something called as contribution. So in marginal costing, variable costs are product costs, which means only variable costs are charged to the products. What about fixed costs? Are fixed costs charged to the products? No. Fixed costs are not charged to the products. Fixed costs are period costs. So when we sell the product in the market, the contribution defines our product profitability. That contribution is like a pool of funds that we collect to recover our fixed costs. So from that we do recovery of fixed costs, and then we arrive at this net profit. So marginal cost statement starts with sales. You remove variable costs, you get contribution. Contribution is like a pool of funds. Why do we need that pool of funds? To recover our fixed costs. And once those fixed costs are recovered, then the organization calculates its net profits. So in absorption costing, we did our cost sheet, right? Remember we did our cost sheet? It's too lesser time to forget it. Cost sheet. Remember, prime cost, factory overheads, factory cost, all of that. Now the cost sheet that we did was as per absorption costing. The principles of absorption costing state that all costs, what all costs, it doesn't matter if they're fixed, it doesn't matter if they're variable, all costs are product costs. All costs are product costs. So in your cost sheet, did I ever tell you that don't take fixed cost? No, right? Every cost is taken in the cost sheet. It doesn't matter if it is fixed, it doesn't matter if it is variable. So when you prepare your cost sheet, whether fixed, whether variable, all are taken to the cost sheet. Finally you get your total cost, then we compare it to our sales, we get our net profit. But in marginal costing, we do not take fixed cost to the cost sheet. So cost sheet will only have sales minus variable cost, which gives us this contribution. So this contribution tells us about our product's profitability. That's it. So the question arises, why do we take sales? Because all my units are valued only at variable cost, because only variable costs are product costs. So opening stock will also be valued at variable cost. Closing stock will also be valued at variable cost. Production also will be valued at variable cost. So instead of showing production plus opening stock minus closing stock gives us sales, like the way we show in absorption costing, we can directly show sales only, no? Everything is valued at variable cost. But that is not the case in absorption costing. In absorption costing, we start with production, correct? Because the cost of production for that period is different. Then we add opening stock. Why? Because the cost of production for the previous period was different. Why was it different? Because of these fixed costs. Why? Because fixed costs have this unique property. See this. The property of fixed cost is fixed cost remains the same in total, but it varies per unit. So say my fixed cost is 1000 rupees. Okay, and say I am manufacturing 400 units. So what is my fixed cost per unit? 1000 divided by 400. So how much do you get? 2.5. Correct. Now in this period my fixed cost is still 1000 rupees. But my number of units are not 400. My number of units are 500. Now tell me what is fixed cost per unit? 1000 divided by 500. So 2 rupees. So see, in the previous period, if I had manufactured 400 units, then I would have charged my fixed cost to my cost sheet using absorption costing. In absorption costing, I would have taken 2.5 rupees. So valuation of stock also would have been as per 2.5 rupees. But in this period, if I am manufacturing 500 units, then what is my fixed cost per unit? 2 rupees, which means I would have charged my fixed cost to the cost sheet and valuation of stock would be as per 2 rupees. Because of which my stock valuation completely gets changed. So I have to take production plus opening minus closing and then arrive at sales. Where? In absorption costing. But in marginal costing, when fixed costs are not product costs only, which means they're not charged to the products, then what am I going to charge to the products? Only variable cost. And variable cost in the previous period also was 2 rupees. In this period also is 2 rupees. So production of this period will be valued at 2 rupees. Opening stock which is coming from the previous period will also be valued at 2 rupees. Closing stock which is left in this period will also be valued at 2 rupees. So I can directly show sales into 2 rupees. Na? That's why the marginal cost sheet starts with sales. Did you all understand? So sales minus variable costs gives me what? Contribution. That contribution is enough to tell you if your product is profitable or not. But we still have fixed costs to recover. So those fixed costs are recovered from this contribution. But fixed costs are not charged to the products. So once I recover my fixed costs, what is left behind is your net profit or loss. Is it okay? So obviously, do you all want to copy this or something? Do you want to copy this? You can copy it. This is the property of fixed cost, which is per unit changes. So after this you can write a note saying in absorption costing, valuation of stocks changes because of change in fixed cost per unit. Because of change in fixed cost per unit. So in absorption costing, valuation of stocks changes because of change in fixed cost per unit. Hence, in absorption costing, we need to start with production units valued at current cost of production add opening stock units valued at previous year's cost of production and deduct the closing stock, in brackets say FIFO, valued at current period's cost of production. Guys, correct? No? This is what we did in the cost sheet. Yes or no? Do you all remember? We did the same thing in the cost sheet. I told you opening stock should be valued as per the previous year's cost of production. If that is not there, then we use current period's cost of production. We also solved a problem on this nano gizmo problem. Remember from chapter 1. So I've just given you what we already know. Now write in marginal costing, only variable costs are product costs. Only variable costs are product costs and charged to the products fixed costs are period costs and charged against the profits of the organization. Since variable costs per unit remain the same, sales quantity valued at variable cost per unit can be directly used. What am I trying to say? Instead of showing production into variable cost per unit, then plus opening stock into variable cost per unit minus closing stock into variable cost per unit, you directly show this is the same, no? But in absorption costing, it's not the same. In absorption costing, what am I doing? Production into cost of production per unit, this is current period, plus opening stock into cost of production per unit previous period minus closing stock into cost of production per unit current period. This is what I'm doing. So here I have to do it. Why is this, and what is the reason for this cost of production per unit to change? Because along with variable cost, I'm charging fixed costs also. Variable cost per unit remain the same, but fixed cost per unit don't remain the same. I have shown you that example by giving you this. Yes or no? So in absorption costing, I'm bound to do that. Only after I do this, I will get sales quantity into whatever value is left. That I'll have to figure out. Yes or no? But here, everything is valued at variable cost. So instead of writing production, then add opening, then minus closing, what is the point? You directly put sales quantity into variable cost per unit. So in marginal costing, we always use sales quantity. That is the reason for using sales quantity. Guys, okay? Everyone. So please write this. So you can actually show this. So this particular thing is under here. This you can just show that this is what happens in absorption costing. Okay, so like I said, marginal cost sheet starts with sales quantity into selling price, gives me total sales, correct, minus sales quantity into variable cost, correct, that's what we calculated here. The cost gives us total variable cost, gives us contribution. So if I were to write contribution in terms of formula, then contribution would be sales quantity into contribution per unit. Okay, sales quantity into contribution per unit. So what is contribution per unit, guys? So contribution is sales minus variable cost, that is in total. So contribution per unit will be selling price per unit minus variable cost per unit, correct, minus minus fixed cost. This whole thing will be recouped from the contribution, and this will give us our profit or loss. Okay, now obviously if contribution is greater than fixed cost, will I get profit or loss? Profit. So more the contribution, more will be the profit. If contribution is less than fixed cost, then the organization will incur a loss. You can actually copy this. Guys, okay. So this is the marginal cost statement. Now we need to understand certain indicators of decision making. Okay, certain indicators of decision making. So when it comes to marginal costing, we have 3 indicators that we need to look at. Okay, what are those indicators? First one you already know, profit volume ratio or PV ratio. Guys, where did we come across this? Which chapter? We've already come across this PV ratio. We've used it also for calculation. Which chapter? Not material. Guys, labor chapter. Remember, in that labor turnover, contribution lost out because of unproductive hours. So that's where we had seen PV ratio. So what is PV ratio? PV ratio is nothing but the percentage of contribution on sales. The percentage of contribution on sales. So see this here, from this particular part. Which part? This part. You can very clearly make out that sales plus variable sales minus variable cost gives us contribution, correct? Right? So if I take variable cost on the other side, what will I get? Sales is equal to variable cost plus contribution. So in other words, can I tell my sales is made up of variable cost and contribution, correct? So if this were 100%, what percentage of sales is contribution? Is your PV ratio. So that is your PV ratio, profit volume ratio. So if sales is 100%, what percentage of that 100% is contribution? So let's say that contribution is 60%, which means PV ratio is 60%, which means out of sales, 60% is contribution. So I'm trying to tell it in different ways so that you understand. So that is your PV ratio, which means what is the remaining 40%? Variable costs. So that is called as variable cost ratio. That is called as variable cost ratio. So please make a note of this, write this, and do this. This is your PV ratio. If we take this as an example. So PV ratio was contribution by sales into 100. I have given you the PV ratio in this problem. Example 60%, which means variable cost ratio is 40%. How? So what is the formula for variable cost ratio? 100% minus PV ratio. Guys, correct? No? So now you tell me, you know what is PV ratio? The percentage of contribution on sales. If my PV ratio is higher, is it good or bad? Higher the PV ratio, the better it is or the worse it is? Better. Why? Because if more PV ratio is there, if our PV ratio is more, then our contribution will be more. And if our contribution will be more, then net profit will be more. Yes or no? So let's write higher the PV ratio, more profitable the organization. Lower the PV ratio, less profitable the organization. Now that you know what is PV ratio, this entire statement that we drew here, this one, can be given in the form of a formula. Okay, so I'll tell you that formula. So this statement, the first part of this statement is written here, correct? Sales minus variable cost gives us contribution. Now, we know that contribution minus fixed cost gives us profit or loss, whatever the case may be, right? So this is one part of the statement. This is the second part of the statement. Or can I say contribution is equal to profit plus fixed cost? I've just taken this fixed cost on the other side. Yes, same thing. Guys, correct? No. So if I equate this and this, what will I get? Sales minus variable cost gives me contribution, which is nothing but profit plus fixed cost. See here, this is also contribution, this is also contribution. So what did I do? I equated both. Guys, correct? You want to copy it down? Copied it. Please copy it, guys. Don't ask me to tell you to copy it. I cannot do that. You have to copy it yourself. These are the extra points that you're going to add to your notes. It's deemed, it's understood. Now there's one more formula which connects everything. Okay, that is, if you come to your, okay, since we are writing the formula, we'll write it all in our book only. Let's not go to our concepts. One more formula is desired sales in value will be equal to fixed cost plus profit by PV ratio. How is this formula the same as this formula? How? See, PV ratio into desired sales. PV ratio into sales gives us what? Contribution. Because PV ratio is contribution by sales. Yes or no? So PV ratio into sales gives us contribution. And contribution is fixed cost plus profit. Correct? Okay. Suppose the same formula. Okay, I want sales quantity, not sales value. This is value, right? I want sales quantity. Then what will I do? Desired sales quantity will be fixed cost plus profit divided by contribution per unit. So contribution per unit into sales quantity is total contribution, which is nothing but fixed cost plus profit. Right? Okay. Now, under PV ratio, I want you to write one more formula. PV ratio is 100% minus variable cost ratio. Correct? Guys, one more formula is important for PV ratio. Please write down. Change in profit by change in sales into 100. Change in profit by change in sales into 100. This is used when profit and sales of two different periods have been given to us. And if we have to calculate PV ratio, then we can use this formula. Now don't ask me how did we get this formula. Why? Because we need to derive it. So in the regular batch I derive it. But now we don't have the time to derive it. So please remember this formula. So PV ratio is change in profit by change in sales into 100. Which means I need profits of 2 periods. I need sales of 2 periods. Guys, this is okay? This is all about your PV ratio. Shall we move on? So let's move on to the next indicator. BEP. BEP. What is BEP? Yes, break even point. Guys, break even point is nothing but that level of sales. What? Level of sales at which no profit, no loss. That means how many units must I sell so that I'm neither making a profit nor am I making a loss. Okay, so the formula for BEP value, that means your sales value. What is the value of sales that you must make so that you're neither making a profit nor are you incurring a loss? Formula is fixed cost by PV ratio. Fixed cost by PV ratio. How fixed cost by PV ratio? So we know that PV ratio is equal to contribution by sales into 100, correct? So I'll remove the 100, I'll take percentage here. Okay. Now I need level of sales at BEP. So let's assume this is my sales value at BEP. Okay. So BEP sales will be what? Contribution by PV ratio. But at BEP, contribution will be equal to fixed cost. Only then I'll get 0, no? Only when contribution is equal to fixed cost, I will get 0. So at BEP, contribution is equal to fixed cost. So I just substitute this here. Once I substitute this here, I will get BEP formula. Fixed cost by PV ratio. Guys, okay? And similarly, if I need BEP in quantity, then fixed cost by contribution per unit. I'll get quantity, no? Contribution per unit into quantity gives me total contribution. At BEP, fixed cost is my total contribution. So you think this is total contribution. Total contribution by contribution per unit gives me quantity. So this will give me quantity. But instead of contribution, what am I keeping here? Fixed cost. Both are equal anyways at BEP. Guys, okay? If you don't want to use this formula, for BEP quantity, you can also use BEP sales value by selling price per unit. Guys, correct? No? Sales value by selling price per unit. What is sales value, guys? Selling price into quantity. If I divide it by selling price, I'll get what? Quantity. So that is BEP quantity. Because I'm taking BEP sales value. Guys, okay? So first formula was this. This was how we arrived at this formula. This is important. At BEP, fixed cost is equal to contribution. Second formula was this. And third formula was this. Make a note. Now, if I get higher level of BEP, what? Higher level of BEP. So, higher BEP Is that good or is that bad? What do you mean by higher level of BP? It means I have to sell more units to come to my break even point. So is that a good thing or is that a bad thing? Why is it a bad thing? Because it shows that my fixed costs are taking very long to recover. So higher the BP means fixed costs take long to recover. So think about it. If an organization can sell only 20,000 units, let's say the market demand is only 20,000 units. Okay. In that BP is 18,000 units. BEP is the point up to which I have recovered all my costs. Fixed costs are done with. So only beyond BEP I'll start making profits, right? If I am at BEP, no profit, no loss. BEP indicates I've recovered all my costs. If there is anything less than BEP, then obviously it means I have not recovered my costs, which means I'll be making a loss. So only anything beyond BEP would mean profits, which means up to 18,000 units, I'll be incurring a loss. At 18,000 units, I would have recovered all my costs. So I'll be at a position where I'm neither making a profit nor I'm making a loss. So only beyond 18,000 I'll be making profits. So for how many units will I be making profits? Only 2,000 units. Hardly anything. Imagine another organization, same scenario. Market demand is only 20,000, but the BEP of this particular organization is say 10,000 units. Which scenario is better? Obviously the second one. Why? Because when the organization is selling 10,000 units at BEP, that means at 10,000 units only I'm recovering all my costs, which means anything that I sell over and above 10,000, the whole thing contributes to my profits. The whole thing becomes my profit. Yes or no? So obviously higher the BEP, not a good scenario. Why? Because it would mean that I'm going to take longer to recover my fixed costs and my profit generating capacity could be lesser. Is it okay? So write that also. Fixed cost take longer to recover. Profit generating capacity could be lesser. I've used the words could be. It's not necessary, it will always be. Here market demand was my restriction. If there is no such restriction, then maybe the organization will generate capacity. Standalone profits, it will generate. Here I'm comparing, so I'm telling you. Guys, okay? Similarly, lower BEP. Lower BEP means fixed costs are recovered faster, which means profit generating capacity will be more. Will be more. Guys, okay? Also, please write down sales and impact. So if I'm selling less than BEP, equal to BEP, more than BEP, what happens? Less than BEP means loss. At BEP means no profit, no loss. And greater than BEP means profit. All this may be there in your book, but you write. No problem. Guys, okay? Guys, okay, we'll move on then. The third indicator, MOS or margin of safety. MOS or margin of safety. Guys, see this example. I gave you this example just now. BEP was 18,000 in this case, and here it was 10,000. Margin of safety is nothing but the extra sale you make over and above BEP. So in this particular first case, what is my margin of safety? 2,000 units. And in the second case, what is my margin of safety? 10,000 units. That is what margin of safety is. So what will we write for margin of safety? Margin of safety is nothing but total sales minus BEP sales. Minus BEP sales. So margin of safety formula will be profit by PV ratio. So that is if you want the margin of safety in value. That is what was the value of sale, that extra sale that you made over and above BP. So you need to take profit by PV ratio. How do you get profit? See here in this formula. Okay, in this formula, what is total sales also? If you take the formula of PV ratio, what was PV ratio? Contribution by sales. If I make sales the subject, what do you get? Contribution by PV ratio. Correct? And BEP is what? Fixed cost by PV ratio. So PV ratio LCM, correct? What do you get? Contribution minus fixed cost. What is contribution minus fixed cost? So this is how you get the formula for margin of safety in value. Similarly, margin of safety in quantity. You want to know how many units you sold over and above BEP. So one formula is total sales quantity minus BEP quantity. Right? Total sales quantity minus BEP quantity. So in case 1, what did you do? 20,000 units minus 18,000 units. So this is one formula. Another formula is margin of safety in quantity, profit by contribution per unit. This is formula number 2. And formula number 3, margin of safety into quantity or margin of safety quantity will be margin of safety value. This is ultimately sales only, no? Divided by selling price per unit. So without wasting any more time, let's go to our problem.